Christopher Peel, the Chief Investment Officer of Tavistock Investments, is still with us. You were just commenting actually to me that you agree with Jamie Dimon that normalization is the right thing to do in this environment.
I think he's spot on the money. The fact is that the QE programs were designed to stimulate economic activity following the recession that started in 2008. It will be unwound, and the process of unwinding will be painful because the clearing level of yields will have to rise almost irrespective of what happens in the short end of the curve. But I think it's the final step to getting back to normal monetary policy on a global basis following the deep recession from 2008, 2009.
And of course the Europeans and the Brits have also dragged their feet on that front. US has very much been leading the charge. There have been multiple comments coming out of Fed governors and various other people in the markets recently about where the Fed are going to end up at in this cycle. And some people are saying that neutral rate, so the underlying target rate that they will get to, is about 3%. Beyond that, they would be overshooting. How many more hikes do you think are left out of the Fed, and how many are you anticipating to see over the next year or so? Only the reason I ask this because other people are saying that at some point what we're going to see is growth slow down in the US, and Fed will be in a very tricky situation because they've overhiked.
I think our base case is the Fed hikes next week, probably one more time in December, and then 2 or 3 times next year. And I think that gets the funds rate back to a level closer to equilibrium from where we are in the growth cycle. But I think the more relevant level of rates is really what happens to the yield curve, the U.S. Treasury curve, but also on top of that, the corporate bond spreads. There's been an enormous increase in the amount of U.S. Treasuries that are going to be financed over, because of the Trump tax package changes, and also the size of the bond market itself. Corporate bond market has more than doubled in size since 2008, 2009. All of this will mature. All of it will need to be refinanced. So I think investors and bond traders are going to have to get used to a gradual rise in rates, irrespective of what the front end is doing. It's the back end that is going to weigh on investment portfolios over the next 1 to 3 years.
Is it making you a little bit more cautious about risky assets? The last time we had 10-year yields up here, obviously we had that big shakeout in February for US equities. With this point in time, we've got 10-year close to 310-ish, we're getting there. Do you think beyond this, if the yield sell-off keeps going, that US equities could look a little bit exposed?
I think US equities will start to look less better value the higher interest rates track. I think you're going to have to see rates, 10-year rates for example, north of 3.5% with inflation around 2, so real yields around 1.5 before equities start to look bad value. So I think that there's still another leg up in the US equity market. Fundamentals are very good. Earnings have been stellar, and the core fundamentals remain intact.
So then how are you positioned in this market then? We've got obviously the trade war narrative in the background. So far there hasn't been so much of a tangible impact on the US economy, but we are seeing it in Chinese markets, which are very much in a bear market territory. But the other narrative is one of the Fed tightening as well. So where do you see opportunities putting all of those things together? How are you playing it?
Simplistically, I look at the 2 biggest economies in the world, that being the Chinese and the US economies. Combined, they're growing above trend, and as long as the combined growth of those 2 countries remains intact, I think the rest of the world will continue to benefit from that. So I'm not as pessimistic about EM as a lot of people are at the moment. I think there's been some problems in a handful of EM countries, Brazil, Russia, Argentina, Turkey, South Africa, and the contagion to the wider EM space has been overdone and presents an opportunity primarily in equities as opposed to bonds currently.
And you haven't reassessed any of your views based on the trade tariff situation that's going on in the world. Particularly, I asked this also with the focus specifically on the tech sector. As we know and as we've discussed, in the last couple of days, tech was very much front and center of this next round of tariffs and what that would mean for supply chains there.
I think our view on tech is it's very hard to value. I mean, we would love to buy the NASDAQ 100 without the top 5 stocks in it, mainly because it's hard to value how that these valuations are incredibly high, but in the core of the technology sector, I think there's value to be had. So it's trying to pinpoint sleeves of various sectors.
All right, Chris, I'm going to have to leave it there. Thank you very much for joining me this morning. Christopher Peel, Chief Investment Officer from Tavistock Investments.